All right, everybody, thank you as always for listening and watching this time. We have another special retirement planner guest episode. Today I'm joined by my friend Eric Niergarth. How you doing, Eric?
Good. How are you, Andy?
I am super, thank you. So Eric is based in San Diego, and I'll let him chat about the rest here about himself and his firm. But before we start, Eric, I just want to tell you that my wife told me that this isn't working between us. For starters, I'm sick of your stupid jokes. So I said, I see. How about for the main course? No, because just the starters, she was, no. Anyway.
Okay. There we go.
Terrible.
There we go.
Anyway, now that's out of the way. So Eric, tell us a little bit about yourself, your firm, and we'll go from there.
Yeah, so I'm the founder of Retirement Roadmap Financial Planning. It's a virtual first firm located in San Diego, California. I will say when I launched a few years ago, your firm was pretty instrumental in the design of my firm. We were value aligned in a lot of ways when I launched my firm, but you and a number of other planners out there have been instrumental in how I've crafted my own firm. And so it's a virtual first flat fee firm out of San Diego, California.
Okay. I'm just curious, do you have any in person, like if someone wanted to see you physically, would you, or everything's awkward question, but people are going to ask.
So I've had prospects that I've met up with. I really enjoyed meeting up with them. I think at some point I might pull the trigger on an office, but San Diego, the city's really big, and I've got maybe 10 clients in San Diego, but it's like some are in North County, some are in East County. And, to get from my location to where they're at, it's a good 45 minutes. And I don't think most people would actually come in if I offered a Zoom alternative.
Right.
But I've been enjoying meeting up with prospects in person, and just it is a different level. But to answer your question, no, as far as meetings go, no, it's virtual first right now.
Okay. Which, like you said, many people actually like that better. I think at some point doing a face-to-face just to say hi, if nothing else, but otherwise conducting the business virtually seems to be working really well. So,
yeah, definitely so. And I think a few years ago, I think you went on like a business trip to go meet your clients. Are you still doing that, or is that something you've enjoyed?
Yeah, I definitely enjoy it. I still do it a few trips a year to various parts of the country. I usually try to sync it up with like either a conference or some whatever, other personal reason to be there. And I'm slowly making the rounds. I haven't quite met everyone yet, but right. More than half I've met, which is cool, and I like it. I appreciate seeing them. We just go to dinner or lunch or something, right. Put a face to the name, and vice versa. I think they like it as well. But when it comes to the nuts and bolts of actually doing the advisory work in the meetings, like everyone seems to be completely fine with Zoom, and it works, and email and phone,
right.
And all that stuff gets the job done.
For sure.
All right, so a little more about your background, if you don't mind. So you started your firm a few years ago. What'd you do prior?
Yeah, so launched in November 2022, so just over 2 years old now. Prior to that, I was with two wealth management firms in San Diego here. So one, they focused on real estate investors, whether it's their own individual rentals or limited partnerships, and also business owners. So a lot of 50-year-old people owning their own business, looking to exit the business within 5 to 10 years. And then I worked with an individual advisor on Coronado Island. He had a really big practice for a solo. He was just a traditional retiree. And he was with LPL. And both gave me a really, really great experience in tax planning and just a broad array of planning aspects.
Yeah. So that one sounds like that was more your sort of formal intro into the retirement aspect of things, whereas the other one was mostly real estate focused.
Sort of. So the retirement focused firm, they were a little bit lighter on the planning. I would say tax planning was almost absent, where it was the business owner and the real estate professionals, and they did have some retirees. That team was extremely in depth in tax planning, and I think that's what really gave me a passion for tax planning. And ironically, like the retiree, it was more of the the 1% where I've obviously geared my firm away from that model.
Right. Yeah. So you are a flat fee, like you said, and that flat fee includes management of investments, right?
Correct. And as it stands now, it's like I can manage it if they want to, or I'm still at the phase where if they want to hold on to the custody and do the trades themselves, they can do so.
Yep. Do you see that ever changing by any chance, like going toward requiring yourself to manage it, or you think you'll be okay with continuing on with the choice?
So far, it's been working out.
Yeah.
I'm running into some of the roadblocks that you've mentioned in the past. Like people, you give them advice and they might not do it, or it's like, hey, it's time to rebalance, and they might not get it done. And I think it's just agreement where it's
Yeah.
like, hey, I'm giving you this advice. It's important that you go do this, and if you don't, that's sort of on you. And we're just trying to work around it. Whether it's the tax planning or the income planning, it does complicate things when they don't do things that we talk about. But if they're doing things, then I have no problem with it.
Yeah,
Sure.
of course. Super smooth then in that case.
Yeah.
All right, before we get into the meat and potatoes here, what's one random or interesting fun fact about yourself that's not related to finances or retirement planning?
Yeah, I would say I'm an avid pickleball player, like most people nowadays. But the fun fact was I've been playing for over 20 years. So it seems like when COVID hit, pickleball blew up, and I would still go play, and I would be like the youngest person there by a mile.
Yeah.
But in high school, we had a pickleball unit all throughout high school, and played some beyond high school. So I've been playing for like 20 years, and now it's like the public's just finding the sport fun.
Okay. Yeah, that's interesting. So I graduated high school in 96, and we played pickleball briefly. Like, they'd rotate through various activities as part of gym class.
Yeah.
And I remember we did pickleball briefly. I was like, oh, this is a weird but cool game, and never thought anything of it. Never heard of it again until a handful of years ago. I didn't know it continued to be a thing for the last 20 years. So that's pretty cool.
Right. Yeah, for sure.
Good for you. All right, getting on to some of the specific retirement-ish questions about you, your experience, your firm. What's an area of retirement planning you think consumers often overlook or don't give enough consideration to? And the flip side, what's an area you think they give too much consideration to many times?
Yeah, I think overlooking the thing that keeps coming up is tax location strategies.
Okay.
Most of my prospects, they're not implementing that. It doesn't get a lot of traction outside of, the podcast world that you're in. And I think like Rob Berger, you guys talk a lot about that, but I rarely see it outside of those channels. And it does make such a huge difference. I know Right Capital, I don't know if you use Right Capital, but they just rolled out a tool that sort of shows, the benefit of doing so. And for me, that's something that I've had to explain to a lot of people, just the concept, and then show them the benefit. And obviously, I'm in the same boat as you, where it's like, hey, Right Capital, they show you the benefit in numbers. We don't really know if that's going to materialize, but directionally, people definitely understand shifting their growth assets into tax-free buckets and then de-risking and pre-tax buckets. Intuitively, that makes sense to a lot of people. And I just think it's something that most retirees are overlooking. And if they're doing it, maybe they could be doing it in a little bit more aggressive manner.
Yeah.
What's something I think people give too much credit to are withdrawal rates. People come to me whether they're living by withdrawal rates or they're talking about withdrawal rates. Two things are wrong with that. One, it's nobody has a static withdrawal rate year after year. Like spending is dynamic, income is dynamic. Whether it's one spouse retires or Social Security kicks on or an inheritance happens or long-term care happens, like spending is dynamic in nature. And to give so much focus on a withdrawal rate is just a silly venture to try to plan your retirement around that. And then secondly, I think people forget that the main reason withdrawal rates are mentioned is in like a worst case scenario. This is how much you can withdraw every year in a worst case scenario. And I don't know if most people want to plan for the worst case scenario without ever tightening the belt in down years, knowing that if they were willing to, they could spend a lot more.
Yeah. I think that makes a lot of sense. And that's what people don't think about or realize. A lot of people get hung up on like the 4% rule, which again, I hate the word rule for that, but
right.
To your point, no one lives a static distribution / spending or expense lifestyle. And that research that became known as the 4% rule assumed you keep up with that distribution every year plus inflation, regardless what happens and how bad the markets are. In reality, like you said, people will adapt and respond. And so I can't quite put a number to it, but maybe you start off with like a 5 or 6% withdrawal and just tell yourself, I'm going to need to be agile. If things get ugly, I will pull it back a little bit, or, whatever it may be. So,
yeah.
So since you brought that up, I want to jump ahead a little bit with the withdrawal thing, which is, I'm glad to hear you say that. No one's yet said that on this show about an area that people spend too much attention on. And I agree with you. I think a lot of people get really hung up on that. But while we're on the topic of distributions, just skipping ahead here, what's your approach toward helping people with distributions and figuring out how much to take out, how much isn't, do you have enough to take a certain amount out or whatever?
Yeah. Yeah. So I think the first step is understanding what that cash flow looks like. So understanding their income sources, Social Security, assuming they're retired and assuming Social Security is on. So Social Security, if it's on, pension, if they have any. And on the expense side, taking a look at their upcoming expenses, their lifestyle, their tax hit if they're doing Roth conversions, any like one-off goals, and just building out the cash flow charts. I use Right Capital, and I think it does a great job showing the variability of cash flow. And typically we look at like the next 5 years. Hey, what does that look like? What's that, after Social Security number that you're going to have to come up with from your portfolio? And then from there, most of my clients, they really like the idea of a bond ladder. So just taking those next 5 years and buying a treasury bond that corresponds with when they're going to need that capital.
Okay. So you're pre-earmarking the anticipated distribution for the next 5 years, let's say. And then
Correct. Yeah. I mean, if they have a higher risk tolerance, we might go 3. If they have a lower risk tolerance, we might go 7. It's really dependent on what they want and just what I glean from the risk tolerance and things they've said in the past.
Right. Okay. Good. Makes sense. For people who choose to work with an advisor, what questions do you think they should ask? What things should they look for, et cetera, when trying to find and due diligence on a potential advisor?
Yeah, I would say, knowing how they get compensated is obviously important to me, just from a conflict of interest standpoint, and also from, does it make sense? Does that dollar amount make sense at the end of the day? Secondly, I would say, do you do tax planning? I pride myself on being extremely detailed in tax planning and, not pretending it's the be all end all, but really helping people make decisions directionally to optimize their tax life and minimize over their lifetime. So just asking the advisor, hey, what do you do for me in regards to tax planning? Are you doing Roth conversions? Are you looking at my tax returns? Are you doing ACA planning? Are you doing a tax location strategy? I think is super important. Do you do cross-generational tax planning? If I ask you to, tax efficient charitable distributions, if I ask you to, really anything a dollar touches, it usually has a tax impact. And just having the advisor go into detail about that. What's your investment approach, investment philosophy? And hopefully it aligns with that individual. I think I'm a passive investor. We'll probably get to that. But I think if a prospect came to me and said, hey, I want you to be timing the market, that's not going to work, and vice versa if somebody wanted to be passive and the advisor was an active manager. So just making sure you're in alignment from an investment management perspective.
Okay. And random observation or comment about the tax planning thing. So there's a new designation that just launched yesterday called the Tax Planning Certified Professional. I started it. I'm going through it. I want to see what it's all about, because people have asked a lot, like, how do I learn tax? Advisors have asked, how do I learn tax planning? Consumers have asked, how do I know if someone does tax planning or whatever? Right. And so to date, there hasn't yet been any sort of single, comprehensive source of, okay, this is tax planning. It's really just people got to learn it by going through understanding taxes, taking it upon themselves to get as much exposure and knowledge and reading as they can about tax related stuff, and then implementing it and making decisions. But I don't know where I'm going with this, other than saying, like, it's 3 modules. I just started the first one. I'm I don't know, a sixth of the way through the first module, and so far I'm impressed with the content in there. I'm not saying this to say that, hey, consumers listening, make sure the advisor has the TPCP, Tax Planning Certified Professional, because like all designations, I don't think having a designation necessarily makes someone better or an expert or whatever, right? It just means that they went through a certain amount of formal exposure, passed some tests, and that's really about it. But I just want to put it out there that there is at least now like a standardized body of knowledge, if you will, for tax planning that might be worth looking into as advisors. Like, I don't think everyone needs to. If you already know tax planning, it's unnecessary. But for consumers, just to be aware of it. We'll just put that out there. I'll recap people at some point down the road when I'm done with this program to let advisors and consumers alike what I think my thoughts are on it. But I'm happy to see that designation come into existence because I think tax planning, like you said, such an important thing, and it's been hard to define and hard to really teach outside of just like figuring out your own throughout the years. So that's all. Thought I'd share that.
Yeah, I'm interested to see your thoughts on it. Like other advisors, I'm just piecing it together through podcasts, through webinars that Wide Capital puts on, and thankfully we have the tools, and I'm excited. There's a more formal course out there now.
Yeah, I mean, the piecing it together is fine. That's how I learned. Is as long as people have the interest to put in the time to find the material, whether it's IRS publications or seminars or whatever, you can learn all this stuff, right? So I know you're sharp in it, and other folks I talk to are sharp in it just because they put the effort in to do it, right? So again, I'm not saying people have to have this new designation. I just thought it was interesting that there is one now, and I'm glad to see that there is kind of more centralized spot for people to go pick up tax planning knowledge. Okay. So what are your go-to spots or sources for retirement planning content, whether it's to learn updates or figure out new things or whatever it may be, or just stay fresh on industry trends?
Yeah, I would say Kitsis obviously is a great source. The XY forum, I think, is a great source to just stay updated on things rolling down the pipeline. Your Facebook group is really great for staying abreast on things coming down the pipeline, just people commenting on new laws coming out or new situations they've got in their own life. IRS publications, if it's like in the nitty gritty. Holistic Plan's done a great webinar series about tax planning. If I can get it in a webinar, that's usually my preferred method. And then like for more formal training, it's like the American College, I think, has a great series. I've done the RICP, CFP before that. But nowadays it's usually just like Kitsis and the bigger podcasts out there.
Yeah, which makes sense because, I mean, you already know all the backbone of this stuff. You're not learning the fundamentals right now. It's like staying abreast of changes and tax law updates and whatever, and places like kitsis.com are great sources for that. So,
and it's been pretty like breakneck speed lately. The past 5 years have just had so many tax changes that it's really hard to keep up with I would imagine for most lay people.
Oh yeah, definitely. Consumers, I don't know, like the whole thing about required minimum distributions and rules around it. People are destined to fail. Like, if you are just a consumer who isn't immersed in this day to day, even advisors, a lot of advisors struggle with this stuff. So I don't know. The IRS needs to revamp that whole RMD process, in my opinion.
Yeah.
All right. So some practice-specific questions. How do you know if someone, a potential client, is a good fit for you, as opposed to them deciding if you're a good fit for them?
Yeah, I would say just having a base knowledge of the topics that I talk about. A lot of people have come to me through like the flat fee world where they're getting steeped in these podcasts like yourself or others out there. And they do have a great base knowledge of Roth conversions or ACA planning and tax location at times. And it's really refreshing to work with somebody where, we don't have to go through that formal education process before I start rolling out formal recommendations. It doesn't mean that's a requirement, but it does make the engagement go a lot easier, and we can get to the important things a lot quicker, as opposed to like fighting the headwinds of, maybe somebody not understanding why they might be paying taxes today if they can kick the can down the road. And thankfully for the most part, that's been really refreshing to have that be the case.
Okay. Now, I know obviously retirement is your focus, so people in or near the distribution stage of life, but outside of that, any particular sort of niche or, types of people or other ways you would classify people as ideal clients for you?
Yeah, I know niches. You're supposed to niche as narrow as you can. And I probably could go narrow from a marketing perspective, like the 5 years out, flat fee, tax focused. I would say like some micro niches are real estate investors, business owners, and I'm amassing some clients like in the pharmaceutical world and the oil and gas world, where it's like if you get 3 or 4 of them, it's like a lot of what goes on under the hood of their benefits packages and the planning areas that they deal with. Okay. So I would say those like 4 micro niches.
Interesting. Real estate. So I just had a call yesterday with someone who a handful of years from retiring, but owns 7 rental properties. And I say, I'm not interested. Thank you. That's just not something I want to deal with. So
Yeah, yep.
I know a guy now, so
Yeah,
I will reach out to you after this recording to, well, I'll reach out to this person, I guess, to get them your information. But it's good to know, because I'm always looking for people when potential people come to my firm and it's like, no, I'm sorry, we're staying in our lane. This is not in our lane. I'd like to have someone to refer them to that would be a good fit, instead of just saying, sorry, we can't help. So good to know your little buckets here. Thank you.
Yeah, for sure. And I think being flat fee is really important for somebody working with real estate investors, because there's not that incentive to say, hey, this isn't cash flowing, you should sell it. You know, I thankfully feel really unconflicted when I'm giving advice and letting them lead the conversation. Hey, you know, what happens if I turn this into a managed property as opposed to self-managed? Or, you know, what happens if I sell it or 1031 it? You know, I'm really agnostic to what they decide. I'm just helping them make the best informed decisions that I can.
And that's the beauty of flat fee. It's almost so obvious it's painful. And I hate to keep beating the drum about it, but it's like, you're getting paid for advice. You know, you can say that's for your time, for your knowledge, for your expertise. It's not for asset size. It's not for specific actions or inactions. It's like, you're getting paid for advice. So, and that's, it's almost so simple it hurts to charge a flat fee. But I don't know, whatever. I don't want to rant about that, because I easily can. Okay. For clients that weren't a good fit after the fact, so they're already signed up and they were clients, for whatever the reasons are, you know, you decided this isn't working out. Have you ever voluntarily parted ways with someone? And if so, are you able to explain without giving client info, obviously?
Yeah, no, not yet. Thankfully, not yet.
Okay.
And I've had 2 clients leave voluntarily. One, he came on board and he was going to sell an insurance practice, and that was like his entire net worth. And he ended up sticking around for a few more years. So he's like, hey, I don't have assets. I don't have planning. You know, I started this prematurely. And then the other couple, they just left January 1st. And they were so well steeped in this. You know, they're on new retirement. I forget, they just rebranded. But yeah. But you know, she was so knowledgeable in these areas, and she was doing her own planning and her own tax projections. You know, she really just wanted a spot check on her retirement, and we worked together, I think, for 12 or 18 months. And you know, she's going to go to DIY, which she's really well positioned to do that. And I think she's joining the Rock Retirement Group coming up here. And so, yeah, those are the only 2 people that have left my services, but I haven't had a client say, hey, this isn't a good fit just yet.
Yeah. It's hard when that happens. It's assuming they're nice people, right? If they're jerks, it's a different story. But if they're jerks, I'd like to think they wouldn't have got through your screening and wouldn't be a client in the first place. But sometimes it just happens. The fit's not there, or circumstances change. You're no longer comfortable with it or feel you're the best fit for it. And that it's not you, it's me, you know, breakup process is never easy to do. Okay. Management of investments. You already touched on the fact that you are a passive approach type person. You use some individual bonds, it sounds like, for a few years of bond laddering. Anything else you're willing and able to share about your views and process and approach towards investment management? Don't list specific like tickers or securities, so people take this as investment advice. But
I would say, to sum it up, I'm sure you've seen the Carl Richards Venn diagram, where it's like the 2 circles. Let's focus on the things that we can control and the things that matter. You know, really, I'm a bogglehead at heart. I keep things extremely low cost. I keep things really passive, as tax efficient as possible via like the tax location strategies. But yeah, just really passive index funds, but doing so in a manner that's tax efficient, and helping the client just get market returns. I know sounds like a low bar to set, but market returns are great returns. And I think the more complicated you make things, the more people want to adjust things or focus on something and look for solutions when it's not going right. And you know, thankfully, most of the people that have signed on, they're already in that boat of being a passive investor, and they're boggleheads at heart, and they understand that the investment management's not a huge part of it. Yes, we do a lot of tax optimization there, but they're not expecting me to beat the market. I'm not trying to beat the market, and it's really just as low cost of funds as we can get in a tax efficient way.
Have you had anyone reach out that did want more of a slant or a bias toward stock picking or sector allocation or whatever? And you know,
Yeah, I would say a big one is like the international. They want to go all US, and we just have a conversation. If their plan can support that added volatility, I'd model it out for them and say, hey, it might be better off in a total returns type approach, but it's really about not missing out on a decade. And I think that's the biggest situation that's come up as far as investment management goes, is people wanting less international and more US exposure, or no international exposure, where we have a conversation around that. And sometimes it lands going with international, sometimes they don't want international. As far as like their own stock picking goes, usually I try to silo that and say, hey, you can play with 5% or 10% if you really want to. And I think the biggest thing with that is, what guardrails are you going to put around it? Are you going to have a benchmark? Are you going to benchmark it against your other assets? Are you going to have the minimum positions? It's going to be a 10 position portfolio, 50 position portfolio. And, I do have some clients that have that desire.
Okay.
As well.
The international one is interesting. I'm just going to comment briefly. So I feel the same, having international exposure, true international exposure, and not just like indirectly the argument that the S&P 500 is large global companies that have, internet, whatever. Yeah. I still firmly advocate for a good chunk of people's stock exposure should be international. We'll call it roughly a third. And I invest that way myself personally. And I keep saying, like, since the financial crisis, U.S. has just absolutely trounced on the rest of the world. And it's hard to keep reiterating the message of like, yeah, I know the last 15 years have been unimpressive for international, but look at the first 10 years of this century, and, international outperformed U.S. Not to say it's guaranteed that'll happen again, but I keep coming back to, I know the prudent, diversified, pragmatic answer is you should have some true international exposure. As much as it's been relatively a dog compared to the S&P 500 for the last 15 years, right. I keep pushing for it. So it is an interesting conversation. Some clients completely get it, and they're like, yep, I understand. Others keep asking, like, why do I have international again? I'm like, that's a great question. I can't knock you for asking, but here's why. And I reiterate the, my answer. But one day it'll happen. It'll come back, and international will do better. But
yeah, it's super difficult when the news just talks about the S&P 500. Even in down years, they'd still be talking about the S&P 500 and not international. And then as well, we're all experiencing recency bias, but now recency bias is like 15 years old, and it's tough to see before a time when the S&P was the dominant player.
And even to take it a step further, the S&P returns have really been dominated by the top handful of behemoth tech companies. If you look any given year, more times than not in the last 15 years, it's like the top 10 companies and their performance accounted for the vast majority of the S&P's return. The rest of the 490-ish companies, is like, returns were So I'm not saying you can, cherry pick and slice and dice out certain names. The S&P is what it is. It's concentrated and whatever. But if you peel back the layers a little bit, you'll see it's really just the performance has been the top 10 big tech companies. The rest of the U.S. has been okay. It hasn't been bad. But when you view it that way, like international doesn't look like as much of a laggard.
Right.
Maybe that's just me trying to defend myself. I don't know. But sounds good in my brain, at least. All right, benchmarking and performance. So you already said you try to get people market returns, which I think is a great approach. With that said, do you provide any sort of, here's what your portfolio got, here's what X, Y, or Z benchmark got, and do any sort of comparison?
Yeah, I don't, just because one, you can cherry pick a benchmark. Yeah. And I don't think it's appropriate for me to try to assign a benchmark for a diversified portfolio filled with mainly index funds, where it's like in an all stock portfolio. In your example, hey, you've got a third US, a third international. Is your benchmark going to be the same? It's like my goal is just to get market returns in those specific indexes that I'm going after in whatever particular allocation. And so for me, it's sort of a futile exercise to try to assign a benchmark. Some years I might do better, some years I might do worse, really depending on what the benchmark is, because there's really no true way to benchmark just a diversified portfolio. And secondly, if we're doing an asset location strategy, there's going to be some rebalancing across tax buckets throughout the year. And it's like, at the beginning of the year, your Roth bucket was a 50-50, but after that conversion, now it's a 60-40. And it just complicates things too much that it's just not worth it. And really, my main goal is just to get market returns. And, I think people can feel that when they look at the returns.
Right. I'm the same way. And I think using just a few funds on the stock side, I typically use 3 funds and that's it. And there's no overlap in underlying positions amongst them.
Correct.
And they're all index-based funds. Right. So your returns are simply a function of how much in each of those funds did you have for whatever the reasons are. And you can easily look at the attribute, whatever your performance is, right. You can look at the attributions of it. These were the 3 or 4 funds that contributed to it, period. And you can look at the returns of each one of those funds and its respective market or index. So I think that's enough for folks to understand their returns and the drivers of their returns. Or at least, if you explain it that way, then clients or potential clients know what to expect, right? If someone knows nothing about you, they may not quite get that answer. But I think the more sort of public and vocal you are about these views and why you do what you do, people get it, or at least the right people that, you want to be working with get it. So.
For sure. Yeah. And thankfully, it hasn't come up that often. People asking about returns or questioning returns, they know what they're on the hook for. They know their exposure. So, yeah. And I think the more you focus on returns and performance, the more they're going to. Right. Whereas there's enough to talk about on the planning side or the tax planning side to fill up a 90-minute meeting typically.
Oh, exactly. Yes. Same thing. I can't tell you how infrequently conversations about the portfolio, the holdings, the return come up. Right. It's more about the distributions, the tax planning, the whatever Roth conversion figure. That's the real core and the value of what we do. And people get that, thankfully.
For sure.
Cool. Alrighty, how about annuities? What's your view, usage, thoughts on annuity? Now, you're not insurance licensed, so I know you don't sell annuities, but
correct, yeah.
Thoughts on them?
Yeah, I think in a nutshell, they're sold more than they're bought, generally speaking. I think they do have, some annuities have their place. I think the most predominant would be the single premium immediate annuity, or people looking for a minimum dignity floor. And I think those are appropriate for people that have a lot of stress around running out of money, where it's locking in a minimum dignity floor hopefully can allow you to sleep better at night, or to maybe take on a little bit more risk if that's what you're looking to do. And, there's obviously no free lunch. It comes with longevity risk and, that asset going away once you pass. But I think it definitely has its place. And thankfully, just because it's such a pure product, there's not a lot of embedded fees in it. There's not a lot of drag to it. It's really just a pure form of longevity insurance. And I have had several clients when we're going through conversations and their risk tolerance and just how they react to certain events, you can tell that they would benefit from such a minimum dignity floor where, they're locking in their essentials with Social Security plus immediate annuity just to cover their basic needs. And, whether they go forward with that or not, it's really up to them. But it's definitely something I've recommended for certain individuals in the past. Where you get into the more complex ones, I'm not a fan of it, mainly because, for me and you, it's probably very hard to understand. For a layperson, it's almost impossible to understand.
Right.
And when you throw in a product into a plan that's impossible to understand, not only out the gate, but 2 years from now or 5 years from now, it's how did that annuity, how is this thing supposed to work? And what are the underlying rules? I'm just not a fan of injecting those types of products when I feel like a passive investment approach is going to return just as robust returns and probabilities of success.
Yeah, agreed. I think it's not fair to say annuities should be viewed from their quote unquote return, but right. Generally speaking, someone who lives to average life expectancy, if they do use an annuity for guaranteed withdrawals or income, like a single premium annuity, if they live average life expectancy, the return they'll get is something like 5-ish%. Depends on the market level of interest rates, but maybe 5%. You live longer, congrats, you beat the house some and you get more. You die earlier, you probably get less. Now the annuity may have some sort of death benefit or whatever, but versus a well-invested passive portfolio, very likely could do better than 5%. There's no guarantees, but chances are it will, right? So there's that. But it's hard to compare because annuities, again, the good ones, the clean ones, the pure ones, you're buying insurance, you're buying, you're de-risking something, and there's a cost to that, as there should be, to take variability off the table. Just interesting phenomenon. There's something called the annuity puzzle or annuity dilemma. I don't know. I've heard it called different things, where people say that, or people in the industry, often it's those who sell annuities, will say people love pensions. Everyone would love to have a pension. The more pension income, the better. No one's ever going to say, I don't want a pension. But people have this knee-jerk adverse reaction to annuities, which functionally could be nothing more than a pension at their core.
Right.
People are like, no, I don't want an annuity. I hate annuities. Now, there's lots of reasons for that. There's lots of bias and bunk information out there about annuities. But my view is, sure, people love a pension. They don't realize there's a cost to it. The cost is all else equal. They're getting lower wages throughout the year because the pension is borne by their employer.
Correct.
Versus when you have an annuity, it's very salient. Is salient the right word? Like, it's very in your face what it costs you. And it's hard to part with $500,000 to buy yourself this private pension. And that's why, in my opinion, people struggle to get okay with annuities when they love the idea of a pension. So,
yeah.
Anyway, doesn't make annuities bad, but I get the hang up about it.
And even immediate annuities, like, they're not without risk. Like, I think the last few years are a great example. Inflation has, people that bought an immediate annuity in 2020 or 2019, might not have had an inflation rider. And if it did, it was maybe 2-3%. But now, fast forward 5 years, they're looking at, purchasing power being maybe 80% or 75% of what it used to be, because that inflation just didn't keep up with what actually took place in the marketplace. And so, I mean, even then, it's not a risk-free venture.
Correct. That's what a lot of people overlook, is inflation risk is probably one of the bigger risks in annuities, because the vast majority don't have inflation adjustments, and those that do, you pay for it. So,
exactly.
No free lunch, nor should there be. But how about trusts, the plain vanilla living revocable trust? Now, you're in California, so your answer may be a little more pro-trust, but
very much so.
Okay, so what's your views? Are you one of the type of people who is like, yeah, everyone should have a living revocable trust, full stop, or is it more situational?
Yeah, I think for my typical client base, where they're 50 and above, they've got a substantial amount of assets. They typically own their home. I think it's a no-brainer, just because probate is so expensive in California that passing through things via trust avoids that cost and complexity. That it's a no-brainer for almost all of my clients in California here. I've got some that are much younger, no kids, not a lot of assets, and those are like outlier clients that it doesn't make sense to go through that process. That it's sort of up to them. But yeah, almost all my clients, it's a typical hard stop recommendation. And then as far as like who do I recommend you work with if you don't have somebody, that's sort of based on complexity. If it's a really simple situation, it might be like a trust and will. If it's more complex, second marriage, special needs, etc., that's usually when we bring in a referral.
And so you mentioned trust and will. For those who don't know, that's a tool kind of made for advisors, where it's like an online will and trust creation place where advisors can help facilitate and sort of piggyback the process and oversee the process for the client. Do you actually use trust and will, or that was just something
so I think they started as retail facing, and then they added on an advisor platform.
Oh, they did? Okay, I don't know that. Okay.
But I use them personally for my own trust and will, and for simple situations, I recommend them. It's just a really clean process, and really affordable for simple situations.
Right.
They still have to go fund the trust themselves, do the deed transfers, retitling the accounts, etc. But it's a really great platform. I actually don't have an advisor portal. I don't do the walkthrough. I just say, hey, go through the process. Here's the link. And when it's done, just send me the documents and we'll go through them and review them. And obviously, I'm not a lawyer. I don't provide legal advice. It's just a high-level review of what they've outlined.
Yeah. And then, like you said, trust and will is good for very basic plain vanilla stuff. Anyone that has more needs or complexity, like, do not use I don't want to say it's cookie cutter, that has a negative connotation, but don't use like a simple solution like that.
Yeah, and I know they're adding more features, but I think most clients would be comfortable working with an estate planning attorney for more complex needs.
All right, cool. How about long-term care insurance? Or let's step it back. I mean, long-term care planning in general, how do you help approach that with clients, whether they should consider traditional insurance or not, or self-fund?
Yeah, so I think out the gate, when we begin the planning process, we talk about what that need looks like. I start the conversation, hey, my default is, let's talk about 2 years in your area. What's that going to cost? What are you comfortable assuming? Do you have a family history? Do you have family that you have, that you can plan on caring for you? And I find most people, they have strong opinions about it out the gate, what they want to assume, the costs they want to assume, if they want insurance or not. And so that's the starting point. As far as like, do I recommend them go buying long-term care insurance? It's typically no. What I've found, products today, they're really expensive. The lifetime benefits are super low, and there's really no guarantee that premiums are going to stay the same. And like some products, like you could do like a single premium, but in that instance, you could just also invest a single premium. And it's like this paradox. If you need this care early, you've got the assets to pay for it. If you need it much later in life, you had time to grow your investment if you earmarked assets for that. And so, yeah, it's typically a no. One argument I've heard that I really like to get insurance is like if you have multiple kids and you want to avoid any arguments against them, like, hey, should we get care for mom or should we get care for dad? Like if you have a policy in place, like you let your kids know, and inherently your kids are going to have the insurance company pay for what is owed to the clients. Right. And so I do like that argument. Yeah, I mentioned that to all my clients thinking about it, and it's really up to them to decide, hey, do we want to quote this out and go through this process or not?
Okay.
And then like people that come to me, a lot of people surprisingly do have policies when they come to me, and we just look at the benefits, look at the premiums, talk it through. And I do find much older policies have a much greater benefit and structure to them.
And higher price increases to account for that.
For sure. Yeah. The last few years have been pretty brutal. And there's sort of this sunk cost that they're feeling. It's like, we've been paying it for 10 years. It's, they have this bias towards continuing to pay it, but the benefits still remain the same. And those are typically much more robust than what's being offered today.
Right. Definitely. So distribution plan, we talked about the general process for helping clients figure out and map out distributions, and we jumped ahead before, like we talked about. Anything else you'd want to add to process, deliverable, whatever, around coming up with a distribution plan for people?
Yeah, I don't think so. I think just mapping out the cash flow, trying to do our best, knowing we're not going to get it perfect, but trying to get within, 20,000 if we can of what that spending target's going to be. I typically build it out with U.S. Treasuries. I think people like that because it's stable. They're matching the maturity to when they're going to need it. And, some people do tips if they desire inflation protection, knowing they're paying a little bit for the hedge there. But yeah, I mean, beyond that, if there's like a greater need, then that's when the tax planning comes into play. It's like, are they going to trigger an IRMA threshold? Do we tap a Roth? Do we, wait until the year's over to do a bigger distribution? But I think for the most part, my clients really like the idea of a ladder, and it's simple. It's something they understand, and there's that like psychological buffer there where it's like they can tune out the markets if there are volatile markets. Hey, we look at our account, we've got 5 years of U.S. Treasuries coming up, and here's our cash flow charts, how much we're anticipating for those years. And I think it just provides a lot of peace of mind for the client. And obviously that bond bucket is part of their overall bond allocation for the asset allocation.
Yep. Okay. But just where that bond allocation is partly in bulleted ladder maturities as opposed to just like a total market bond.
Correct. Yep.
Cool. So you mentioned tax planning. It's a big part of what you do. Common tax planning opportunities you come across, and I'll give you a freebie. Like Wheel of Fortune, they give everyone RST, LNE, or whatever. Like Roth conversions. Yeah. We know that's one, so you don't have to belabor that point. But above me on that, tax planning opportunities you commonly come across.
Yeah, tax location, again, I think it's a huge benefit. Over the very long term, just shifting those assets towards a tax optimal location, should provide a large benefit in tax alpha. It's just sort of like, the proverbial free lunch, just moving things around. You've already got the buckets, you've already got the assets. Let's just do it in a tax optimal way. I think that's huge. Other ones you talk about all the time: IRMA planning, ACA planning, cross-generational planning. I do have a lot of clients that have kids that they want to say, hey, let's minimize the tax burden, not just across my lifetime, but my kid's lifetime. If they inherit pre-tax assets, we take that into consideration when we're mainly talking about Roth conversions. Hey, can you pay this at a lower bracket than what your kids might inherit it down the road? And some people, they want to do that. Other people, they don't want to do that. That's totally fine by me. Right. Tax efficient gifting. A lot of my clients, they want to do a donor advised fund if they're still working in higher brackets. They want to gift appreciated securities if they have QCDs are big, 170.5 hits. Just all the big ones out there.
Okay. Like all the things you rattled off is interesting. These are definitely tax planning things in working with retirees that clearly you're well versed in and know of them. There's a lot of folks out there, consumers or advisors, who this is so foreign to them. Like, what is tax planning? Like, you just hit on 10 of them, right? So,
and it's so unfortunate. A lot of it's timely. A lot of my clients, they find out about your podcast or they find out about somebody else's podcast and like, oh, I'm 68 and I've got $2 million in a pre-tax IRA. Like, I just found out about Roth conversions. I've got Social Security and a pension and a rental property, and my withdrawal rate's like 2%, and I'm staring down the barrel of some whopper RMDs. I just wish I found out about this sooner. And it is sort of painful to get those clients, but thankfully most of them have time. RMD's starting at 73 now, and those years are important. And you're doing a great job of informing the public. I think a lot more people are realizing the importance of tax planning. And your podcast is a big part of that.
And it's never too late. It's a cheesy saying, but something along the lines of like the best time to plant a tree was yesterday. The next best time is today, right? Yeah. Like, doesn't matter if you're 68. In a perfect world, sure, it would have been great if you started this at 50. Yep. You didn't get over it. Like, let's do what we can do now. So And I don't know about you, but it seems like without fail, the last 3 years now, I've had people come to me in November or December where it's like, I just found out about this. Like, I should be doing Roth conversions, and they, we try to fit it in if it makes sense. But every lapsing year makes a difference. Yep, definitely. So we talked about distributions and helping people map those out. And I guess this question or comment is sort of like the inverse way to look at that. So I guess the distributions presuppose the client has enough assets to retire. You're not figuring out how much they can spend from that enough figure. Looking at it the other way, if someone new comes to you and is like, I don't even know if I have enough to retire, do I? Yeah. Like, how do you help them figure out whether or not they have enough? Yeah, it's always sort of surprising when we go through that process, and I'm in a good position to tell them, hey, you could have retired 5 years ago. And it's always interesting to see how people, I hope they're not putting off retiring to meet with somebody, and I wish they would have done it sooner if that's the case. But typically the starting point is, hey, let's build out a comprehensive financial plan. Let's take a look at your income sources, whether it's jobs, Social Security, pension, etc. Your spending. I do hammer home spending. I really like to understand what their discretionary spending is. I find that when people just say, hey, I'm spending $8,000 per month, we pop open the hood. I use Monarch Money, if you're familiar with Monarch Money. Mm-hmm. And they could be $1,000, $2,000 off per month. And so really zeroing in on that number to a realistic degree is helpful in cash flow planning and financial planning. And then from there, we just do like a typical Monte Carlo. Hey, here's what you're expected to need from your assets. Here's what assets you have. Here's how you're invested. And how does that hold up in a Monte Carlo simulation? And, thankfully, more times than not, they're on really solid footing when they find me. And I think it is just most people, they're steeping themselves in these podcasts, and inherently those people have been savers their whole life, and, working professionals, and, thankfully they're in that position. But it's just the typical tools. And then from there, we talk about, hey, what levers do you want to look at? Is it retiring sooner? Is it spending more? Is it gifting more? Is it leaving more? Mm-hmm. And you hit on a great point. It really all starts with expenses in all of this. Yeah. If you don't have a really good handle, now granted, no one knows with certainty what they're going to spend in 5 years, 10 years, 20 years. But if you don't know with certainty what you're actually spending and what money you need today per month, per year, there's like no real way to come up with a good plan, because you're kind of flying blind, right? It's all based on how much you need. That then figures out whether or not you have enough. So
Yeah, 100%.
there's no easy way to do it, right? You mentioned Monarch, but there's, whether it's Quicken or YNAB, you need a budget. Like, you have to go through the homework of knowing where your money's going in detail for at least a year, if not 2 years, just so you get a full cyclical snapshot of how much you're actually spending throughout the course of life cycles and stuff.
Correct. And that's tough. I mean, usually Monarch, they'll them for like 3 to 6 months, and it's a shorter snapshot. We try to clean it up to make it look like a typical quarter. And then it's just like the starting point for buy-in. Hey, here's the categories. Here's how much you spent. Like, is this a reasonable quarter? And then from there, we can go back historically as time passes, just to make sure they're tracking on that initial number that they came in at.
Okay. So you mentioned a lot of your clients are in the fortunate position where they do have enough, can retire or could have retired earlier. But, as we know, there's a really hard emotional hurdle to going from an accumulator, diligent saver to now, not only you're not saving money, but you're going to start spending what you've been saving for the last 40 years. Yeah. I know you're not a therapist. I mean, we all need to try to play the role of therapist a little bit, but how do you help people? Any tips or tricks to get over that emotional hurdle, whether it's showing them other results or reports or like objective things, or you just kind of try to have heart-to-heart conversations and feel out what the real pain points are and, tease out how to address that?
Yeah, I would say that's the $1 million question. And I think that's like the most frustrating part about my job so far, is that I don't know if you experience this as well, but it's definitely a common thing where people will have a rock solid Monte Carlo, and they've just sort of been ingrained at spending, 5 or 8 or 10,000 per month. And it's just hard to tell them, hey, you could be just fine spending 15,000 per month and, still leaving a really strong legacy plus the house. It's just a big psychological hurdle. I think it's the fear-based, hey, am I going to run out of money type hurdle? But it's also like how they view themselves. So I'm not the type of person to spend 15,000 per month. I'm just fine on 10. So there's both of those hurdles in place. And then, we just try to have conversations around, one of the biggest regrets people do face in their 80s, if they have, fortunate market returns, they wish they would have done more in the past or given away more to, people or things that were important to them. And, if they say something in passing, I've had several clients say, hey, you're so right. I just had a good friend or a coworker pass away, and they were, 68. They retired last year, and they didn't get to enjoy it. And it's not a enjoyable thing, but it's like, how do we sort of use that unfortunate situation to help them get motivated to go enjoy their life to the fullest, or give to sources that are important to them while they're still alive, and not have that regret that probably a lot of retirees are facing right now. If you look at the last 15 years, like we talked about, it's been bang out returns. I would imagine a lot of 80, 90-year-olds have a lot more money than they thought they would at that point in their life. Yeah. And they probably wish they would have, taken another trip with their kids, or, given to those charities that were important to them, or whatever it is. But it is a really hard thing to try to get people to do, just because you are competing against fear and that self-image that they have. So I don't know. What about you? What have you been coming up against?
All the same struggles, and I think it's a combination. Depends on the person, and frankly, some people just never get comfortable with it. There's people where their total withdrawal rate is like 2% of their portfolio, right? Yeah. And that covers everything. Yeah. And it's just, I don't want to poo-poo it, but it's easy for me to say, like, look, that's dividends and interest alone are 2%. Like, you're not even touching principal. Go spend it. But I try not to be insensitive and too blunt about it, because some people, whatever their childhood was, or money scripts, or relationships with money, or debt, or lack of money growing up, that's permanently burnt in their brain. And some people just never get over it. They will die with way too much money. Yeah. Yes, I'll have the regret on the deathbed, probably, but it's easy to look back and say, well, you should have spent more. Some people just won't. They struggle. So I realize there's some cases where the best I can do is just keep reiterating the facts objectively, tell them it's okay, and let them do their thing. For some people, I do think an annuity can be a good solution for the permission to spend, not for the entirety of your money, definitely not, but like the endless cup of coffee idea, like a pension, right? People love pensions because you spend your pension this month. You know what? A new one shows up next month. So I do have some clients where I have recommended that as, if nothing else, just sort of like a way to address the emotions of being reluctant to spend, thinking that that would let them give themselves permission to spend a little more. But for better or worse, I think most people who find me in this podcast and probably find you, a lot of people are inherently against annuities because they travel in the circles of, nope, I'm an indexer, I'm a keep it simple, I'm a Vanguardian, I'm a whatever, no insurance product. And I think that's a little unfounded and misplaced at times, but it is what it is. I'm never going to force a client to get an annuity. There are a few clients I'm like, I really think you should get this. It'll be good for you. And they're just like, I get it, but not going to do it. So, not fighting them. So it's hard. I'm in the same position as you. More clients than not can definitely spend more, and it's hard to get them to do it. And I realize I'll be 47 in a few days. I'm young. I still have 20 plus years of work. And as much as I say I understand and can appreciate the emotional difficulty they go with, I realize I have no idea, right? Because when you're 60 or whatever, and you realize, you know what, I don't have the ability to earn income, or if I do, it's some relatively small retail job, if my mind and body allows. Me at 46, 47, I can always go back to work and get money. Or, not go back, I'm currently working. But I always know where my income's coming from. I can always get more if I want. I can get less if I want to dial it down. You're retired, that's it. Like your nest egg is what you got, plus Social Security and whatever. So as much as I say I get it, I realize, like, shut up, Andy, you don't. You have no idea what it's like until you're in that position. So I try to walk gingerly around that.
Yeah, it's really easy to give that advice in our chair. I totally get that. And I have that same experience with Roth conversions sometimes, where it's like they're on this tax time bomb. It's like, hey, you really should convert to the 22 or 24, otherwise you could be in for a world of hurt. And it's sort of that same thing. It's like they don't want to cut the check just because it's too painful. And it is so easy for us to give that advice. And you're totally right. Just knowing how much hesitation we face, it is, we won't know until we get there, type thing.
Right. So this next question, I'm looking forward to your answer. This is a brand new question for this year. This was actually a listener and client recommended this question. I was like, you know what? This is a great question. So for those, in case people are wondering, last year I used the exact same script with every advisor who was on. I think I changed it once or twice, but it was the same questions. For this year, I did cut out a handful of questions. So if you notice, the runtime's a little less than these episodes normally are, and there's less questions. That's why. I thought some of the questions were a little fluffy and unnecessary, so I did trim some out. But this one I added in. You were the first one to get it. Hopefully you don't crash and burn. No, just kidding. What do you feel your biases are and how you approach planning, products, strategies, etc.?
Yeah, I would say simplicity. I obviously don't have an insurance license, and I think just keeping it as simple as possible in the investment management piece, in the cash flow piece, and for lack of a better word, avoiding some of those more complex products that, they might provide a slight boost to Monte Carlo scores. Yeah. But if I have a hard time understanding it, and if a client has an impossible time understanding it, it's just not worth it. The lift, if there was a lift to be had at all, isn't worth it to me. And so I just always err on the side of simplicity as far as investment management goes, and cash flow distributions go. I think a ladder is probably as simple as it can get. You could argue maybe like a bucketing strategy would be more simpler, but I like the psychological benefits of a ladder. So I would say simplicity, and then like the tax side is complete opposite. It's like we go super deep on the tax side, and I feel like that's where we can provide alpha and people understand it. But it's simplicity on the product side is I would say a bias. Yeah, at times.
Same for me. I value simplicity. I don't want to say to a fault, because that implies like I know I'm doing something wrong, and that's not in the client's best interest. If I felt I was disadvantaging clients because of my bias towards simplicity, I would not be as simple in things. But I'm with you. There's the industry, not just insurance, but Wall Street and the investment and securities industry. They are in the business of making shiny new objects and creating products to sell. And that doesn't mean products are inherently bad, but a lot of stuff is just like, I get it. I see how it works. Could it make sense? Sure. I can come up with a scenario where this will end up being good for you. But is the juice worth the squeeze? Is the difficulty in explaining it and clients understanding exactly how it fits in, what it's going to do, is that worth giving up the simplicity? My view is oftentimes not, but only, hindsight will tell. Would this complicated product have been better than a simple approach? I don't know. But we can control simplicity, right? Like you said before, control what matters and control what you can actually control. I think simplicity or lack thereof is one of the levers we do actually have the ability to dial around or toggle on or off. So good answer. All right, final questions. Excuse me. If you can give only one piece of advice or word of wisdom to listeners about retirement planning, what would it be? And this is directed toward consumers, not other advisors.
Yeah, I would say there's so many rules of thumb in our industry. 4% rule, or the 60/40, or de-risk when you're entering retirement. I would say don't confuse a rule of thumb for advice. It's just a guidepost. And I'm never surprised at how many people are living by rules of thumbs. And I'm obviously biased. I'm in the business of giving advice, but I would never tell my parents, hey, stick to this rule of thumb. It's just, a lot of times they're just completely misunderstood or just completely don't apply to the situation that the individual has. So yeah, don't confuse a rule of thumb for advice. It's really just a guidepost at best, I would say.
Great. I'm with you on that. And finally, where can people go to find out more about you, your business, anything you want to share about yourself, your firm, stuff you put out?
Yes, I'm the founder of Retirement Roadmap Financial Planning. That's the website as well. And if you guys have any questions, just feel free to book a time, and I'm happy to chat with anybody further.
Okay. And there will be a link to your website and the notes to the show. Thank you very much.
Awesome. Well, thank you, Andy. It's been a pleasure. I appreciate you having me on.
Yeah, this was great. Thanks for coming on and sharing. And thank you for being the guinea pig for that question about first one having to answer what your biases are. That's a tough one to answer.
I'm glad I did not crash and burn there.
You did not. No, I think you did well. So very good. All right.
Happy birthday. I think we share a birthday you mentioned. Happy birthday on Thursday.
That's right. Coming up soon. Yeah. Cool. Thank you. And happy birthday in advance. All right.
Thank you so much.
Take care, everyone.